Okay, hi everybody. Look, I'm lucky enough to have Alesha, founder and partner at Tax App Accountancy. Alesha, thanks for joining me.
Thanks so much for having me, Gianni.
Very good. Look, Alesha, the talk of the town is budget reform changes. It's been a week now. A lot of people are running scared and they don't know what to do. They're starting to look at implementing changes to counterbalance the effects of these budget reforms. What is the first thing that people need to understand before they go ahead and make any changes?
Yeah, that's such a good question. I think I'm seeing so much content out there telling people to restructure ASAP or the next property or investment they make needs to be in a specific structure. But I think we just all need to hold our horses for the minute because it is a proposed budget. It hasn't been legislated yet. And this is a proposal by the government. And we understand that the government has majority. They just need the Greens in the Senate to be able to approve it. But the Greens are going to, perhaps throw some curveballs out there. And just because something is proposed, I don't think we need to go ahead and change everything. In the proposal as well, there are rules around, for example, if you are sitting in a discretionary trust or if you have got, properties in that structure, there is going to be rollover relief. So we need to just work with the government, see what changes will get legislated, and then work and change our course based off of those.
Yeah, look, 100%. I agree. Firstly, because there's a political process that needs to be undertaken. It goes through the Senate and House of Representatives. And even though the Labor Party have the majority in the House of Representatives, the Greens probably have the next biggest share in the Senate, and it needs to go through the lower house before it goes to the upper house. So any changes could really occur before it's passed as legislation. That being said, in a few sentences that are at a super high level, what are the major changes that we're seeing occur or as a result of these budgets? What are the high level things that particularly property investors need to understand?
Yeah, for sure. So I think the high level changes are that negative gearing is getting scrapped for established properties every time you purchase after the budget night. So if you weren't in a contract before the budget night, going forward, you won't be able to negative gear your property against your wages. Now, but for new properties, you still will be able to do that. And for commercial properties, that is still there. So the negative gearing still remains for commercial properties. In terms of CGT, they are now impacting all asset classes. Talk residential property, commercial property, shares, crypto, any asset class that you hold, they will be impacted. And from the 1st of July 2027, we will no longer have the 50% discount that we used to have if you hold an asset for more than a year. So what's going to happen is we're going to bring back an old rule, which is indexation. So we used to have indexation back in the day. Indexation is pretty much just saying if your asset has increased more than the inflation for the specific year, you have to pay tax on that. So that's effectively what's going to happen for each year. We're going to add in indexation and then we're going to pay the CGT based
No,
off of that. So there's lots that's still not clear though, because
mm,
this is just a high level proposal. There's some fact sheets, but the level of information as an accountant that I would like to get for the tax treatments, and I'm sure the general public also wants to get, it's not fully fleshed out.
yeah, there's a lot of case studies and scenarios that I've seen floating around, particularly the one of people converting their trust to a company and some potential rollover relief or those sort of, those sort of scenarios. Can you explain some of the proposed counterbalancing scenarios or rollover relief scenarios that people are potentially looking at using?
Yeah. So, for example, once these changes become legislation, the government is saying they're going to give us perhaps 3 years or around about then to be able to get out of the structures that we are in currently and then to update the structures based on the new tax law. The reason why they're doing that is because they understand that a lot of people have purchased assets to amplify their tax situation. And they are allowing everyone who is in a discretionary trust, because there is that 30% slab that they've added with the discretionary trust going forward with distributions, to be able to move out of there and go into a favorable structure like a company, which is seem to be very favored in government's view at the moment. And unit trusts as well, they have been largely untouched when by the government in these specific changes.
Yeah, okay. So that's probably important to note because a lot of people over the last couple of years, I've noticed in particular, have started purchasing property via a trust. It probably goes back to the myth of unlimited borrowing capacity if you purchase in a trust or multiple trusts, which is a bit of a pet peeve of mine. But it's probably important to note that people should understand that there is some rollover relief there. What are the considerations between operating via a trust and operating via a company that people need to understand at a high level? What's the high level differences?
So trust, a family trust or a discretionary trust, that's been slammed pretty much in the budget. It's
Mm,
more of a tax grab budget compared to a relief budget, as the government is trying to sell it to us. But primarily, what they're doing is, with the discretionary trust, things are very fluid,
mm,
because it was supposed to be for a family's nest egg to grow generational wealth. Now, with a company, there's a bit more structure involved. You have to have different share classes. There are minutes involved, which you do in trusts as well. But company is more of a corporate structure. And previously, people wouldn't purchase assets like property in a company, was because the companies didn't have the 50% discount. Now, at this point in time, we're not sure if the companies are going to get the indexation discount either. So if you run faster than the government and sort of go, yep, I'm going to, like, next property that I buy, I'm going to buy in a company, you don't know if you're going to get the indexation discount. But at the moment, we understand that trusts will get it. So something like a unit trust will continue to get that indexation discount.
yeah, okay. That's probably important to understand for those people that are trying to act in anticipation of the government's changes. What about negative gearing more so? If we can go into a little bit more detail around the changes with negative gearing specifically and what the government is doing in terms of phasing out negative gearing?
Yeah, so negative gearing has been a big one, and I've seen quite a few people get quite upset about negative gearing. But there are still strategies that can be implemented, so it's not the end of the world. I don't think anyone was purchasing property because it could be negatively geared. I think people were largely purchasing property because was a good asset class. It was going to grow faster than inflation. If an asset is growing faster than inflation, means that you're growing your wealth. So those fundamentals for any asset that you're looking at would still remain, I'd say. They'd be the salient features of that asset. But with negative gearing, perhaps, what's changed is, for example, if you weren't in a contract before the budget night, you will not be able to access negative gearing against your salaries and wages. Now, if you already own a property, you were in a contract and you were already negative gearing your property, you are untouched. So you don't have to worry about that. You can continue holding that asset. Now, going forward, you can continue to negative gear for new builds and commercial property. So they haven't touched commercial property. They also haven't touched shares. So there are, if this is something that people really want to do, they want a tax benefit of purchasing an asset. There are ways around the government restrictions.
Mhm, yeah. We were talking a little bit about unit trusts as well previously. That's probably something I want to explore with you a little bit later. But in terms of my own personal circumstances as well, or my business circumstances, I've had a number of clients reach out to me and say, well, are we impacted by these changes? Because we're on about a half a dozen clients. I'm literally gone under contract within the last month or two. Some as soon as the week before the budget was announced, and I'm saying, well, look, we've got a contract date of before the budget. So it's important to note that your negative gearing on your property will be grandfathered. So you can rest assured there. Going forward, I feel one of the behavioral impacts associated with grandfathering these negative gearing changes, however, will be that these investors will be more reluctant to let go of their property because they have that grandfathered negative gearing, number one, and they won't be able to carry that forward into other existing purchases. And as a result of that and the larger capital gains tax bill that they're likely going to incur, how will indexation affect those existing purchases that even though they're grandfathered, how will indexation, the CGT indexation method impact those existing properties?
Yeah, I think you've hit the nail on the head with people not wanting to get rid of their properties that they can negatively gear until pretty much forever. But it is important to note that you cannot, and most properties will stop negative gearing after maybe 6 to 8 years of being held. So there does come a time when rents become bigger than what your interest is on your property. So that's one part. The second part is about the CGT impact. So what's going to happen is up till the 30th of June 2027, we pretty much still get the 50% CGT discount. However, so what's going to be really important is everyone who holds an asset as at 30 June 2027 needs to get a valuation of that asset because that valuation will help you get the 50% discount. As of the 1st of July 2027, we're going to have indexation. So if we've got 3% inflation, we are going to be using that 3% to reduce the total tax you'll pay. And we'll keep adding that year on year on year. If you hold it for 10 years, that's 3% times by 10. But I'm oversimplifying the formula. It just means that the CGT calculation now is more complex. It used to be really simple. Now it's going to become really complex. And I think people will also be reluctant to sell because they have the 50% CGT discount. So this is exactly what happened with the 1985 CGT rule. So if people held a property before 1985, there was no CGT tax that you had to pay. So families have held those properties for years and years because they just don't want to sell an asset now. But all of the pre-1985 properties are also included in this. So they've done a whole sweep. So everyone now gets treated equally, which I feel is kind of fair. What do you think about that, actually?
Yes and no. Look, it's a little bit difficult because a lot of those owners would have owned those properties before capital gains tax was even implemented at all. So they purchased those investments under the assumption that they wouldn't be taxed or there wasn't anything in place. Then the CGT changes came in 1985. They were still exempt because pre-1985 you don't pay capital gains tax. Now all of a sudden you're finding that people of that particular demographic, the boomers typically, they are more than likely in their late 60s and beyond. They're all of a sudden they are now subject to not even the 50% discount, the indexation rate, which could be a massive amount considering what their property values have grown by. So all of a sudden you're finding this demographic of people that are typically asset rich and income poor are now going to be asset poor and income poor because they're trying to sell these assets and they've got a massive CGT bill as well. So yeah,
Yeah, but it will be from the 1st of July. So if they sell before then, they'll be
okay,
fine. So they'll
yeah,
go unscathed if they sell before then. So perhaps we'll see some more properties on the market. Who knows?
yeah. I expect to see a flood of properties over the next 12 months. So look, it could be a good opportunity for investors to get into the market because there'll be a flood of supply of people trying to let their assets go prior to 1 July 2027. But at the same time, there will be a lot of people that will be doing the opposite. They'll just be keeping their assets until they absolutely have to get rid of them as well.
Hmm. And do you think it changes the economics of the type of asset that you would purchase for clients, or would that fundamentally be the same?
No, look, personally, I steer clear of off the plan house and land packages for a few different reasons. Number one, legally, they're a little bit of a mess because you're often purchasing property that is not yet completed. So it's sort of subject to design, and you've heard of plenty of horror stories there. Secondly, I'm not a big fan of modern day building standards. I don't feel the quality is up to scratch. And then thirdly, as well, they are often at an inflated price because they have inbuilt commissions and marketing costs and a few other bits and pieces associated with those purchases. Furthermore, I feel that now that there's tax incentive going towards these newer properties, there's going to be even more competition, which will then prop up property prices again. And then another factor that I've only just sort of realized over the last couple of days is new off the plan apartments or house and land packages aren't open to foreign investment review board. So a lot of overseas investors can start looking to invest into these properties as well. Whereas with existing properties, they are up for review by the Foreign Investment Review Board, and normally they don't let non-PR or overseas investors purchase existing properties. So there will be even more competition for new house and land and off the plan apartment as a result.
So they're almost shifting the economics of
Mm.
and the fundamentals of the property market, which is interesting. Or well,
Yeah,
that's what they're
yeah.
trying to do.
Yeah, exactly, 100%. But I think it has some unintended consequences. For me personally, it's always going to be about the supply and demand. Cash flow is king at the end of the day. So ultimately, you don't buy property just because of the tax benefits. I say all the time, even more so now, a tax benefit on a poor investment is still a poor investment. So it's important for people to understand that as well. Maybe just shifting back slightly in terms of different entities. There has been a lot of investment over the last few years into self-managed super funds. How do you feel that some of these changes are likely to impact self-managed super funds in general?
That's a great question. In this specific budget, there hasn't been much talk about the super fund. Now, we saw some changes come through with the super fund like a couple of months ago, and we were talking about those changes for the past perhaps year or something like that. And they kept getting refined over time because the government was getting a lot of industry feedback to see how it would be implemented. At the moment, with super funds, we've got the $3 million slab of assets. So that's where you start accumulating more tax on them. In this specific matter, most super funds aren't necessarily people. If people are purchasing their properties in a super fund, they try to buy a long-term hold property. They don't necessarily want to like chop and change. They're not developing in the super fund either because you genuinely cannot do that. The rules are really restricted around that. And with super funds, I largely see is play on because negative gearing benefits. Most of the time, people aren't thinking about negative gearing in their super fund at all. Rather, they prefer a cash flow positive, not positive, but they want more cash flow coming through the property. So, yeah, largely, I think super funds will remain as they are. And I think perhaps more people are going to start utilizing self managed super funds to purchase properties because of the great tax environment that they've got until it hits the $3 million mark.
Yeah, 100%. Look, I often tell people that it's a little bit more difficult to buy inside your self-managed super fund because of the stringent requirements, number one. But number two, it's not really worthwhile negative gearing inside superannuation because of the low tax bracket. And I always redirect them back to their accountant because at the end of the day, like you're not going to receive that big a tax incentive on a concessional tax rate of 15%. So that being said, you want to have a big deposit, reduce your lending requirements. You want to find property that has low ongoing expenses as well to increase the likelihood that you are either cash flow neutral or even cash flow positive. Because at the end of the day, you want that property to be less of a burden on your superannuation balance or even your superannuation guarantee and contributions. You want it to be less of a burden on your overall SMSF cash flow to put you in a better position to then be able to accumulate more assets for your eventual retirement as well. And then I'm finding that a lot of people aren't really educated on what the goal is of accumulating wealth inside self-managed super fund. Can you maybe detail a little bit about some of the exit strategies people may have when it comes to purchasing property in the SMSF around how they might want to sell it in pension phase or use the rental income as pension payments or something along those lines?
Yeah, so there are a few different methods that people use with self-managed super funds. One is to try and see if they can pay off the property. And that's what happens when you've got a really nice chunky deposit in there to start things off. And most of the time, I'm not a lending policy expert by any chance, but I've got a rough idea that lenders prefer having a bigger deposit. They don't really like having those 5% deposits for self-managed super funds anyway, just because they want to make sure that the self-managed super fund is going to be able to pay for itself over time. Um, a lot of the times what people plan on doing is they will purchase a property and hopefully they'll pay it off with their contributions over time, or the property's rental income will pay for that. And then what they can do once it enters into the pension phase is to sell that asset completely free. A lot of the times, and now this has to be done correctly. You can move it once in pension fund, you can move that property into your personal name and start living in it. So there are a few different things people plan on doing with their self-managed super fund, but it's a highly, highly regulated space. So everything has to be done properly. Your T's have to be crossed and your I's have to be dotted to do it well. But at times people also want the rental income from the property, or once they sell the property, they want to invest in income producing assets. So they could, go to a financial advisor and they can advise them what kind of assets to get. So they get a regular income. Some people like to get, 100K per month, per month, per year. And they go, okay, like I've paid off my house. I just want to get like a regular pension year on year. So different people have different strategies. It just depends on what is going to be the best for you. And sometimes you don't need to have it all figured out when you're first starting it off. So perhaps the first strategy is to, start accumulating assets that are going to grow more than inflation. And then as you get to the retirement or pension phase, you figure out if it's worth selling it, keeping it, having the rental income, and so forth.
Yeah, no, 100%. Look, I think it's important to receive formal advice when you're looking to start a self-managed super fund, and you mentioned speaking to a financial planner as well. One of the issues that I'm finding is that a lot of people are using those self-managed super fund, like the online creator tools, and they just start their own self-managed super fund and they start, doing things on their own. Uh, what are the impacts of people that potentially purchase inside self-managed super fund, and then the self-managed super fund is then deemed non-compliant because they've broken one of the many stringent rules?
So, yeah, I think it's so important to get right advice at the start, because there are a lot of intricacies with self-managed super funds. So, for example, you cannot even take money out of the self-managed super fund's transaction account to then pay for some groceries or to do something like paying for a holiday, if especially if it is in accumulation phase. So you have to be very, very careful because ATO is very strict. And once you do get a self-managed super fund, you have to have it audited every single year, just because ATO wants to see that auditor's report saying that you are not cooking the books, pretty much. So, yeah, there are lots of requirements, and which is why you need to get strong advice so you know that you're in good hands, you know the rules, and you're playing by the rules. Um, Now, a lot of people like using a lot of online tools, and I think that's great to get educated. But something like your retirement nest egg, I think it's really important to get the right advice when you're setting something up like this.
Yeah, 100%. Because the implications of getting it wrong could be very costly. It could literally cost you your retirement and your status as a complying self-managed super fund, which is very detrimental. So, no, please, if you're listening out there, please go get yourself some advice from a registered tax agent like the team at Tax App, or a financial planner as well, who I'm sure Alicia and the team will be able to put you in touch with as well. Alicia, apart from that, I just wanted to thank you for your time on the podcast. If anybody wants to ask you any tax specific questions or anything regardless of the budget impacts, how is the best way to get in touch with you?
Thank you so much, Gianni, for having me. And the best way to contact me would be through our website, which is www.taxapp.com.au. Or otherwise, I'm also on LinkedIn, Alesha Masaud, so you can look me up there.